signs of inflation are appearing everywhere, starting with the US, where corona vaccination is rapidly progressing. The economy is showing signs of a strong rebound, and warnings are sounding that inflation will strike and interest rate will rise. In April, the US Consumer Price Index rose more than 4% compared to the same month last year, and the inflationary shock has come to life. According to the U.S. Department of Labor, on May 12th, the Consumer Price Index for April rose 4.2% from the same month last year. This is much higher than the Dow Jones estimate. This increase is the highest since September 2008, when the aftermath of the global financial crisis occurred. The U.S. consumer inflation rate for April exceeded the market forecast and recorded a 4.2% increase from the same month last year. This is the highest in 13 years. The market forecast of 3.6% also exceeded the expectations. The U.S. economy recovery is a sign of inflation as consumer price and commodity price rise. As this outlook emerged before and after announcement of U.S. consumer price, the Korean and Taiwan's stock markets, which had risen mainly from technology, slapped on these days. Samsung Electronic stock price fell to 7,000 won for the first time this year. TSMC fell close to the lower limit during the intraday and closed down 1.9% in the afternoon after falling close to the lower limit. On the same day, as sales in April decreased by 13.8% from the previous month. The reason that concerns about inflation lead to a hit on the stock market is that the Federal Reserve System is expected to raise the benchmark interest rate, which has remained at zero since the coronavirus faster than expected. The stock market, which had been marching high with the help of ultra-low interest rate, can quickly cool down as interest rate rise. In particular, technology stocks who have been doing business with a lot of loan, looking forward to future prospects rather than the current result, are hit hard. The interest rate of U.S. 10 years Treasury bonds, which surged in February and then fell for a while, are also rising again, putting pressure on the stock market. U.S. Treasury yields exceeded the 1.6% level at the beginning of this month and then continued to rise, exceeding 1.65% on the morning of May 12th. The market is accepting the rise in government bond yield as a signal that the era of the ultra-low interest rate is coming to an end. Immediately after the coronavirus spread last year, interest rate on U.S. Treasury bonds fell to 0.5% per year. The Federal is in a position that it will rise the base rate only if full employment is achieved and the inflation rate actually exceeded the federal target for the considerable period of time. Currently, the Fed sees this point as after 2024. However, its inflation continued to hit the 3 to 4% range for a while. The possibility that the Fed will advance the hike cannot be ruled out. Some point out that the Fed is losing market confidence, and in addition to the fear of the rate hike, the fear that the Fed may not be able to deal with the inflation properly is dividing investors into anxiety